there's a really strong bond between a network and its token. In crypto, if you take Ethereum, if there's no liquidity on ETH, you can't really use the network. So the role for a market maker in crypto seemed to be much, much closer, not only to capital markets, but to the core of these projects that were very linked.
Jakob Palmstierna is the president of GSR, one of crypto's oldest and largest market makers. From building enterprise-grade trading infrastructure to architecting DeFi through Katana, Jakob shares how GSR is shaping the future of digital asset markets.
What's the end goal for GSR in Katana?
Ability to reuse an asset across protocols. And that's really where I can see Katana as the core deep liquidity, DeFi-focused opinionated chain in a few years. And GSR is very involved in RWAs and trading those. But I think that's an important point where I think DeFi is very, very interesting.
Hello, Jacob, and welcome to Alpha Unhashed.
Thank you for having me.
So, Jacob, as president of GSR, one of the leading market makers, I think GSR pretty much started before market making was a thing in crypto, I would say. How did you land up at GSR, and just give me a bit of the backstory?
Well, so I was in traditional finance before. I was at a hedge fund called 2 Sigma, where actually I started trading crypto, PA. And, some reasons for doing that. One was, it seems like a new interesting technology. But another reason was that it was one of the only places in modern finance where you could see how an order book behaved with the naked eye, and you didn't have all the regulations you had in traditional finance. And that was pretty interesting for, looking how execution and things like that works. Obviously, in traditional finance, you have to do it by inference, as opposed to with the naked eye, it goes too quickly. Today, it's the same in crypto. It's evolved a lot. So that was probably 13, 14. And then come 2017, I went into GSR, which at the time was a smaller company, but with a big ambition in order to build out the market maker. So I joined as a partner together with a few other people, and off we went. Trying to build the first enterprise-grade trading infrastructure in crypto. And the reason for that being sort of interesting was that, fast forward from 2014 to 2017, 18, you had this proliferation of tokens being made available by smart contracts on Ethereum. And you had this promise of decentralized finance and a trust layer over the internet. But really what made it an interesting area for us was that there was always more sources of potential tokens to trade with this proliferation. And one thing that sort of was clear to us was there's a really strong bond between a network and its token, actually a stronger bond than it is between an equity and its company. And one way to illustrate that is, if you're out driving your Tesla and there is no liquidity or the shorting within the Tesla stock, your car is not going to stop in the middle of the road. That would be dangerous, and obviously there's no link between the two. Whereas in crypto, if you take Ethereum, if there's no liquidity on ETH, you can't really use the network. So the role for a market maker in crypto seemed to be much, much closer, not only to capital markets, but to the core of these projects that were very linked. So we thought that seemed like a good business in order to be a liquidity provider in that space. And I think we were one of the first. There were other people having the same ideas, but yeah, we pride ourselves as having been here for a long time.
Well, that's very interesting analogy, and yeah, absolutely. I mean, no wonder crypto is Web3, where transaction and finance go together, and so obviously they get so closely interlinked. And how was you moved from Two Sigma, and with the quant hat on, is when you joined GSR at that point in time, how advanced was market making in crypto compared to market making in TradFi markets?
Not very advanced at all, I would say. At that
Thought so,
time,
yeah.
yeah. I would say at the time, the way that what we call exchanges in crypto is really sort of websites, right? So you were integrating through these venues, which had which had a matching engine and a central limit order book, but the connectivity was not at all what it was in TradFi. It was quite patchy, and the APIs was updating all the time. It wasn't really done in the most effective way. So I would say at the time, you didn't optimize for performance. You optimized for robustness, which is a big difference. So the name of the game was being able to be in the books and quote with some level of integrity at all time, and constant changes in APIs and pretty rough data, so on and so forth. So I don't think that at the real time it wasn't really sort of a lot of performance algorithms that were deployed, but really sort of basic market making. We're trying to build really robust infrastructure around it. If the evolution since that sort of early 18 when I came into crypto towards today is sort of a guidance of the rate of evolution that's going to happen, we are on a very, very good path because the market is competitive today.
Okay. So, but would you say that given the the 24/7 nature of crypto and every transaction being available on public ledgers, even though still most of the transactions are happening on centralized exchanges today as far as trades are concerned, the evolution of market making, liquidity from, say, in the last, say, 5 years, 5-6 years in crypto markets, and the technology for managing that, is it now in parallel with TradFi markets, or can we sort of say that actually there's a lot more which has happened in crypto markets which has taken the curve beyond TradFi markets?
If we talk about centralized exchanges for crypto, I do think that they have played more of a catch up to traditional centralized exchanges, and even today, I think that you're when you're talking about pure sort of latency, we aren't really there in crypto by and large yet. Not necessarily sure that's needed, by the way. Whether we transact in milliseconds or microseconds doesn't really matter for most people as long as it's a level playing field. But there are a few different things that separates them. Now we have some some sort of hardware colos for exchanges in NY5, in LD4, but many of them still are cloud-based venues, which means that you can do sort of cloud colo. And I don't think there's been sort of a huge innovation on the central limit order book. That's still how it kind of works. I guess one big innovation has been the perps in crypto, for sure. but if you talk about DeFi, with sort of, how we provide liquidity there with the bonding curves and now sort of decentralized clubs and stuff, I think there's been more innovation there. And it's an interesting topic because it's kind of hard to argue that a club would be, a traditional club would be more performant than an AMM can be more performant than a club. But I think there is, the real excitement about what's happening in crypto is in liquidity discovery on chain. Whether that's payment or trading, or actually composability and more effective use of assets.
Okay. Before we get into, and you sort of went right into the heart of crypto with those few lines, and I think if you could break it down for everyone before we get into the composability aspect around AMMs, how do automated market makers work? How does our automated market making work compared to centralized exchanges and order books, and how is liquidity provisioning, market making different in these two instances?
Yeah, so I think that if you look at if you look at sort of AMM, it's in its purest form, sort of the V1, you basically sort of set off a pool, and as people are set a pool between two assets, and as people are taking out some assets or putting in some other assets, the price will naturally change, and that's controlled by the bonding curve, which is giving you a fee. But and that's how you pay the fee. The main difference, sort of when you are trading in an AMM, is that the price cannot move. Right, the price cannot move unless a trade happens. Right, and your inventory management is happening on chain, so it's quite capital inefficient. Right, in the first order. On a central limit order book, on the other hand, you can place your order at different intervals. You can change those orders as you see fit, even if there's no trade. You can put, obviously maker orders, or you can put taker orders in. What that means is that you have an easier, the price can actually moves without the trade being done, as people are repositioning their bids and offers, and your inventory management is quite a lot more effective. And obviously the matching order, the matching engines will decide who's first in queue and who's not first in queue. So I mean, high level, I think that the original AMMs is a pretty it's a good thought experiments, but a pretty rudimental way of exchanging value. Versus a central limit order book is a very premier way of doing it, and it sort of stand the test of time. Now we move to the V3, where you actually can place liquidity within different intervals, and you can change liquidity within different bands, which makes it slightly better. But putting them side to side, I still think that you will have a hard time beating a central limit order book with an AMM today. And I guess one of the ways to illustrate that is that if you would put an AMM and a club in the same order book, right? Kind of like the hybrid order books, you can choose your two user interfaces, but you can choose but you actually goes into the same. You would most definitely create an opportunity for the trader in the central limit order book versus the people in the AMM.
How just to go into that deeper, a lot of transaction volume has been moving into DeFi, especially in certain primitives or areas. Take lending markets, for example, which have completely flipped CeFi lending in crypto. So similarly, DEX volumes have been picking up significantly as well over time, or especially over the last 2 years. In terms of your market making business, are you seeing that being reflected? Is DEX market making something which is growing at a faster pace now?
Yeah, it's definitely growing, I would say, and it is the emergence of places like Hyperliquid and other perp dexes. It's really pushing a lot of volumes on chain. But even in the central limit order books, we have seen a somewhat of an increase relative to the other. But I do think that the perp dexes has been a real catalyst, because even if you look at centralized exchanges, most of the volumes is happening on perps. So I think finding a way to have somewhat competitive liquidity on chain has really been a good and very exciting sort of development for DeFi. At the end of the day, liquidity behests liquidity. So I think if we are in a good momentum, when you go somewhere and you want to trade, you want to be able to trade with integrity and certainty of execution. And as more people are moving towards DEX for that reason, as opposed to for curiosity and for ideological reasons, I think we're in a good. We're in a good space.
I suppose we're having this conversation in the week of the perp DEX wars.
Yeah. And I think, but that's healthy, right? Oh, do you have a view on it?
It's healthy as long as it's fair. It's being fought fairly and very straight fair. So I'm not entirely sure that's what's happening right now. So one has to see, I guess. You mentioned perp dexes, for example, and the volumes growing there. How as a market maker, or more like you're much larger in your lines of business, much wider than market making, and let's kind of talk about that. What are the different lines of businesses at GSR, and how big is market making within that? And is market making now is market making becoming a bit more commoditized? There are just so many players of different sizes now, and what are your thoughts on that?
Yeah, there's definitely a lot of market makers that's entered the market. I think if we wanted to spend the time listing them all, it wouldn't be hard to list 30 or 40 odd, and I think that's I think that's testimony to it being an attractive place to be. I do think that there are very varied levels of quality of that, and I think that generally you have to especially in crypto, you have to differentiate between, are you a liquidity provider or are you a liquidity taker? So how are you how are you interacting in terms of like what kind of strategies are you using? Are you using them to maximize liquidity, or are you just using them to prop trade? So for us, we market making is a core business for us. Providing liquidity to strong projects is something we still think is necessary and will continue to be, because these network need good and deep liquidity in order to function and succeed. And it helps them sort of reduce slippage, ensuring that people can transact with integrity, ensuring that they have the right liquidity as they go on to exchanges, whether those are centralized or decentralized. But from a GSR perspective, our early partners or customers were token issuers, right? So we worked with them. We worked with over 500 projects going to market today over our over the time that GSR has existed. And one of the things that we very early moved into is into the OTC business. So what you can see is that at the early days, these tokens were just traded on spot, but there were fairly, quite a lot of volatility in crypto, and these foundations had accumulated quite a lot of, they've raised assets in ETH, sometimes even BTC, and obviously when USDT came, they started to raise in those. So that was the money that they were using to sort of enhance the protocol and build it up. But that was also treasury, right? So that treasury could be used to earn yields, and earning yields on those at that time was basically you could do some call over rights and write some options. But the issue with that was there wasn't any options market on screen. So GSR, having that experience from our previous life, was very happy to to sort of write those options and to internalize that risk by giving yield to token issuers and foundations. That OTC business has grown. We do programmatic accumulations, liquidations. We do options and forwards and structured products even for very much for sort of treasury strategies for foundations, but also with associated investors for those, which those are fund investors or private investors, and more and more sort of being a counterparty of an entrance to more institutional clients trying to get into the space. So it's been a pretty good business of sort of evolving the market infrastructure and bringing more people into crypto. So those are two early things. Those almost like day one. We started doing both of those things in through 18 and 19 and 20. At that point, we at that point DeFi started to evolve, and we were there and trading in that space. But it made us natural to sort of expand into DeFi and getting more sort of native trading during this period. And that was also the period where we realized that being this close to founders, we engaged with them very early, and we are close to deal flow. So we started investing out of a balance sheet and building out a venture arm of GSR. So now we end up in this space where we have market making, we have OTC, we have obviously DeFi and ventures. So moving on from that, the natural evolution for us was to programmatically distribute liquidity, is what we call systematic OTC, which is on retail platform, ECNs, and so on and so forth, where you stream in liquidity through liquidity or through RFQs, and that's sort of the full cycle where we have a number of businesses, but they all hinges on the fact that we have a set of capabilities, and these are natural extension of those, and they serve the common franchise of clients that we have. And then I guess there's two other businesses that we should that I maybe should mention. One is obviously with the emergence of digital asset treasuries, we were early to sort of help create Upexi, which was one of the first one on Solana, and we've been very active in that space, both on the asset management side and the investment space and the advisory space, which is a way to distribute digital assets to normal consumers, and hopefully we're also seeing traditional assets coming on chain as much as crypto coming into traditional assets. And then obviously the last one has been from us to move from really being in a trader in DeFi to help evolve it by being a co-creator of Katana, which I know you spoke to Mark about in an episode not too long ago. So that's kind of the range of services that we provide, and I think that kind of puts us somewhere where we like to say that we want to be sort of the premier Web3 capital markets to our franchise.
So in some ways, is there a broad outline vision to be like, say, the citadel of crypto?
Yeah, I think you can look at it a couple of different ways. The way that we look at it is that there's not there's no real capital markets partner to crypto projects today, right? And that's slightly broader than just a market maker.
As a founder of a new project, I can vouch for that. Yeah,
You're right. So I think that trading is a core capability of what we do, and market making is a big part of what we do. And you have to have that sort of aptitude for trading as the market evolves. But if I would be lying if I said that we believe that we would be the citadel of crypto necessarily, I think that we would view ourselves much more as a capital markets partner to the to the founders and the builders of Web3 by one, where we can help co-create, two, obviously being an early investor and helping with the go-to-market strategy, with including the listing strategy, providing the early liquidity both on-chain and off-chain, working to connect them with the network of both investors and other protocols that they should build with, and then helping distribute their tokens systematically onto retail platforms or onto ECNs or wherever that can be. Ultimately include them in asset management products, building option markets on those, and who knows, maybe in the end some treasury company will build a DAT on it. So I think that where we really see ourselves is being a trusted partner on that journey, not for an instant of time, but for a longer period of time. But as you say, trading is a core component of what it do, and those are one of the core capabilities that always will be in sort of the foundation of how we will serve our franchise.
As you kind of outlined it, and if I kind of put them side by side, from your ventures to market making to TC to systematic OTC, DeFi, and ultimately also DATs. So yeah, actually, for a crypto project, it's almost the full a life cycle of sorts, and that's where you kind of the whole vision of being a capital markets partner in sort of supporting crypto companies through this entire journey is quite an apt analogy in that sense. And let's talk about and we mentioned Katana, and I want to dive into that. That was a very interesting what shall I say, initiative from GSR to be partnering up with Polygon for Katana. And Mark mentioned, if I remember, about having this integrated approach to DeFi liquidity. So where do you stand with Katana, and is that vision something which is actually going to be very different in terms of a chain which can really help build DeFi in a differentiated way?
Yeah, I think for GSR to be part of the co-creation of Katana reflects a strategic shift for us from participating in DeFi to help architecting it. I think Mark, I don't want to repeat everything that Mark sort of said, so I'm going to try to take a slightly different approach. But there are a few things that he's also very well articulated on these things. But where we come into this, where for Mark and Sandeep and the Polygon team, it came as sort of a natural extension of the ag layer, or a use case for the ag layer. We come it from a trading perspective, and where we sort of align is this response to liquidity fragmentation and unsustainable yields in DeFi, and this view of having an opinionated chain that really enshrine these core apps around the key use cases, Morpho, Sushi. It made a lot of sense to us, and we sort of came in to work with the Polygon team, and now obviously formed a Katana Foundation, where our role is helping to shape this market design, the LP incentives, and the liquidity strategy. So we are actively, and as well as the business development of what protocol should build on Katana and what makes sense. But really, today our main focus is to make sure that liquidity is flowing efficiently across all the parts of the Katana ecosystem, and in a way, sort of we bootstrapped that, and we're now seeing other participants coming in. So high level motivation for why we are there.
So clearly, moving from being a big market participant to architecting DeFi is definitely a strategic move, as you put it. What's the end goal vision, if I were to say, or end goal for GSR in Katana?
We want to see real, market adoption in DeFi. So there's a few different things that needs to happen, and two of those things is obviously deep liquidity, and sustainable yields. And I think Mark went through how those yields is sort of really sort of going straight back into the core protocols, one through Vault Bridge, through the sequencer fees, through the AUSD stablecoin fees, as well as sort of the initial emissions and protocol allocations to sort of bootstrap the market. I think that one of the reasons that bigger players and traders doesn't participate in DeFi is the fragmentation of liquidity. So if we can solve that, we're somewhat on the way. The other part is there needs to be an attraction. So I really think that there is a reason why on-chain yield can be higher than off-chain yield, which isn't only by the fact that we just print a lot of tokens and we sort of give out them. So the sustainable greed. So and one of them to look at it to look at that is like in TradFi, intermediaries captures part of the yield through opaque rehypothecation, right? And in DeFi, smart contracts distribute the yield more directly to users. So depositors can sort of capture a larger share of what their assets actually earn. So that transparency and the direct accrual is why on-chain yields can be higher. Like they're not risk-free. And you will know this, but I think it's important when we talk about composability, like what does that actually mean in practice? It's that, in DeFi, a tokenized fund unit can basically be reused as collateral in DeFi money markets, enable investors to borrow, a stable coin against their holdings, and they can redeploy that in maybe in the same fund, if it's a low risk fund, to create some leverage, but maybe they can lend out those assets and earn some yield. So they will create this on-chain efficient use of capital that is almost impossible in traditional structure. And it's possible because the smart contract enforces collateralization instantly, reducing all this need for large haircuts that TradFi institutions demand. There is also the case that this in TradFi, that's how institutions make money. But on chain, a lot of the value of a network accrues in their native tokens. So they can afford to distribute more of the yields that creation back to us users. And I think this is one of the strongest DeFi unlock arguments. Not just transparency, but this composability, the ability to reuse an asset across protocols. And that's really where I can see Katana as the core deep liquidity, DeFi focused permission, opinionated chain can move in a few years. And GSR is very involved in, RWAs and trading those. But I think that's an important point where I think DeFi is very, very interesting.
I must say, you've been very articulate about DeFi yield and why it can be higher than, or why it is higher than off-chain yields, putting composability and disintermediation together. So I think that was very well presented, because quite often we tend to speak in very DeFi language and it gets to that space, but this was a very refreshing way of discussing it. So, and I can see where GSR is kind of fitting in, and in this thought of being an architect also at a network level in this. So that's very interesting. And how do you see regulation impacting a large market participant who is present across the value chain as a capital markets partner? How do you see regulation evolving on that front? And it's very interesting that GSR has 2 licenses, one in the UK and one in Singapore. So what's been around that as well? Did you actually need the license also, or is this something that is a proactive step, for example, in Singapore for certain lines of business? So if you could just talk about all of that.
Yeah. So the question is, do we actually need the licenses, or we just collect them for marketing? I think, taking a step back, we've always been pro-regulation, and what that means is, we want a level playing field, fair and orderly markets, and consumer protections. And one of the reasons is that without that, we believe that crypto will sort of live on the fringes of real society, and it will be this sort of like island hopping. And I do think that the promise of crypto, Web3, digital assets, whatever you want to call it, is so much higher than living on the fringes of society. I think it's one of the biggest talent density working within the Web3 space seen since the early internet days. Now matched by AI, but that's a big thing. There's a lot of talent, and that I think is sort of the self-fulfilling prophecy of it. So it is more than a technology, because it is also emerged with the capital markets, and there is a lot of speculation which we need to to one degree move beyond. But if we're going to have speculation, there needs to be regulations in the sense that there's confidence for people that these are fair and orderly market, and there is consumer protection. That's what will bring the next billion users into crypto. So we've always been pro that. I think even back in 2020, 2021, we were in the US. We filed we prepared applications, but obviously the tide turned a bit, to say the least, and we didn't make progress there. In the UK, they came out with the FCA guidance for crypto trading, which are really governing parts of our UK entity and parts of our trading. It doesn't cover everything that we do. You're absolutely right about that. But we're UK headquartered, and we definitely want to promote it and operate it within it. The MAS license in Singapore, they actually designated and actually regulated market making and market behavior. So that's a very relevant, and I think we were first to get it. And it has all these disclosure requirements about market abuse and what you would like to see in other areas. It's covering the Singaporean jurisdiction, right? So it's also at that limited, but I think it's also a way for us to be able to credibly partner with institutions and people, and they can look through what we're doing, and they know that it's eyes on what we are doing. Because however you look at it, crypto has attracted people who might have not transacted with the best intentions at times. I'm not saying crypto is special for having done that. I think that happens in all markets, and I don't think that crypto should be be singled out for that. I think that's unfair, and I think that's a sheep shot. But the fact is that happens in every market, and sometimes I think that some people in crypto thinks that because it's unregulated means that you can do whatever you want, and they miss this little footnote that fraud is actually a criminal offense, and fraud is always fraud, whether it is regulated or not. But overall, we are operating, we are active with the licenses or the regulation that we have. It doesn't cover all our business. We hope that one day we will have a global regulation, and we're certainly excited about the US coming out with clearer regulations, and Europe, and we hope that they will not be punitive but enabling a fair and orderly market with consumer protection that will allow people to trade with integrity and comfort in crypto.
So and you've seen in multiple markets or jurisdictions you operate, the regulation, the regulatory framework becoming more sort of conducive, or is it still great?
I mean, I think today it's going in the right direction, even if everything is not sort of crystal clear. You can, if you operate with integrity and within the rules that are currently set, feeling quite comfortable that you can be in a growth mode as opposed to not. So, obviously wish everything would go faster, but I'll settle on giving a pat on the back for those who's trying to make it happen.
Yeah, I mean, slow, but as long as it's moving forward.
Just not too slow,
Yeah, that's true. Yeah, I mean, it has to do a lot of catching up as well. So yeah. So what's your view on the sort of markets, Jakob? I mean, this week's been very turbulent. I mean, the bottoms. Have the markets found the bottom yet? We have Bitcoin at roughly around what is it right now? I'm just checking.
116.
It's just gone up by 1%. It's 113 now. It's were extremely choppy and going down. And how do you, as a sort of deep liquidity provider, how do you manage risk in such environments?
I mean, I think first of all, sort of volatility is actually not bad for a liquidity provider in general. From that perspective, it's quite good. I think that overall, as a firm, I think we are firmly on the side of wanting the market as a whole to go up, because really what we like is volumes, and for volumes to go up, we need more people to engage in it. For more people to engage in it, the network values will be higher, and obviously with higher prices, the total notional turnover goes in. But I think for us, it's business as usual. As a firm, we've never used excess leverage to any extent. We think that the volatility in crypto is providing enough bang for our buck, and one of the kind of sort of boring sides of GSR, I guess, is that we've always said, we don't want to look like heroes in a bear market, in a bull market. We want to look like heroes in a bear market, and got that completely wrong. But one of the reasons is that the heroes in a bull market would always be leverage longs, and a lot of those tapped out. We know the stories about Three Arrows and others. Whereas, one of the first sort of trader Hippocratic oaths that you learn is that, if you're good at not losing money, you stand a good chance of making money. So I think that within sort of the framework of GSR, we haven't had big drawdowns as a company, and as such, our overall trading portfolio has outperformed Bitcoin, mainly because we haven't had the same drawdowns, but we participated on the upside in a very, very strong way. So that continued to sort of be the way that we risk manage. Not a lot of not a huge amount of leverage across the business, and then taking advantage of volatility. So this is kind of a normal market. We've seen a few big rotations of sellers coming into the market, and that's obviously put some big trades in across the weekend, and then the market is sort of traded down a little bit. But you asked what my view is. I'm very constructive on crypto at the moment. I do think that I wouldn't give you a prediction over a day or over a week or even a month. And even if I did, I would apply randomness to it. But I do think that the overall catalysts that are in the market, and overall, I think we're sort of reached a tipping point, and we can see that with BTC and ETH predominantly, and Solana, and they will I think that they will continue to grow in adoption and price creation, at least on a on a year time scale. What's been interesting is that if you look at DeFi and altcoins, they seem to be sort of pegged at the 2020, TVL and those things seem to be sort of pegged at the 2021, peak. And what does that tell you? I think maybe that is that we've saturated a lot of the existing users in DeFi, and we need more people to come in and adopt the space. Might be true, might not be true, but I do think it speaks to the fact that there could be a rotation coming in, that the altcoins could have a bit of a comeback selectively about across what we would call quality, and I do think working hard around improving sort of the DeFi architectures, the narratives. Very easy for unregulated people to interact in DeFi. I think we need to find a way to be able to act that in sort of permissioned pools and so on, and bring real the yield in DeFi is very, very attractive. Let's say we can solve sort of the operational risk of that and the ODDs, and maybe even sort of the sort of anonymity of flows from big institutions, so they not cause a lot of front running. Then there are really attractive yields in DeFi, but maybe they are not viewed as very sustainable. We talked about composability, but I see no reason why we can't bring the on-chain yield, the off-chain yield on-chain as well. And then you sort of have just a much broader smorgasbord of selections. So that together with, payments and transactions, that's a few really, really exciting stuff going on, and we're certainly quite excited about being active in that space.
No, I'm with you on that. In spite of all the excitement in DeFi and the foundation and the potential of the technology to really redefine how, forget bringing off-chain assets on-chain. It's even native crypto assets and what can be built on them in DeFi is substantial. And what's been happening in DeFi is essentially a loop of leverage and yield. And that's becoming quite commoditized in many ways. And so that's why you can see that DeFi TVL is sort of hovering around that range. So unless there's more innovation on structured products, and the technology is clearly there, there's composability, all the primitives are there, there are DEXs, there are lending borrowing markets, there are derivative pop DEXs over there. So my thesis around building on a protocol has been that in DeFi needs the asset management layer to be able to aggregate all of this infrastructure now to create structured products which are beyond just leverage and yield, to actually go replicating some of the simple to complex structured products that exist in TradFi, be it indexes, ETF, on-chain index, ETFs, on-chain indexes, quant structured products, which is one of the things that we also do completely run on-chain. So yes, I'm a kind of believer in where on-chain asset management will evolve into, and it's also quite telling that today crypto structured products are less than 3% of the entire crypto markets compared to TradFi, where it is over 35-36%. So, and in this, in when you look at the sort of overall market scape from that lens, what would you think, in the next 4-5 years, when this crypto has a $4 trillion market, what's your view in say 5 years time frame, and what do you think DeFi has the potential to evolve into out of that?
Yeah, I mean, first of all, I kind of agree with what you say, that we need to evolve from unsustainable, just sort of high yield and a bunch of leverage in DeFi. As excited as that is, it's not the hallmarks of a evolved market. Versus option vaults, DOVs is versus as a management product, ETFs, indices, and so on and so forth. They are key components in a healthy financial markets where you can express views in multiple levels of way. So I do think that being able to bring sort of on-chain, I'm going to say on-chain return, sort of off-chain returns on-chain, mixed with like intelligent packaging of harnessing of natural yields in crypto, which includes volatility, which includes sort of forward basis, and so on and so forth. and also having, as you say, certain active strategies being deployed in other in fund formats or in structured products formats. So that's the path. I think that we will go, and we have to go. I do think that we need to find these ways for, a way to trade in permissioned pools. I think this part that we talked about, the real killer product in terms of composability needs to be better understood. And so if all of those things comes together, I think we will get to a good place. My personal view is that I think that, people will trade both on-chain and off-chain. But I would say that DeFi is so much more than just sort of exchange trading. And I think that's what we talked about. And I think people are now leaning into, stable coin transactions, peer-to-peer finance. I think there's, huge amount of opportunity set there. And, today crypto or sort of blockchain with the way that is architectured is not as fast as traditional finance. I think we talked about that before. And I'm not seeing it being faster. So if it's like pure HFT trading, you can hyperliquid, very fast for being on crypto. We're not talking microseconds still. So we're an order of magnitude off at least, and there's a variability in latency. That's not necessarily a bad thing if everyone is having it at the same place. But I do think that the centralized exchanges today is price leaders to the decentralized places, but there might be other ways of operating. But by and large, if you have the right level of depth in liquidity on chain, the prices will be roughly balanced between them. And for any individual, you will not give away that much if you're trading on chain but off chain. So then you get the natural selection. Where do you want to operate? And if we in that kind of process also can significantly improve the UI UX of interacting in DeFi, I think we'll move away from the degens. So all of those things are really good, and then I think keep focusing on what's the litmus test that we need for traditional investors to come into crypto. They can do all their audits that they want, but at some point we gotta keep testing the same underlying, and it shouldn't break. And once it's gonna process a significant amount of throughput as everything else, people get dedicated. At least the operational part of feeling comfortable with DeFi, that I think would be sold. Compliance, protecting fund flows as they get published on chain. Maybe double click on that to explain it a little bit clearer. But if you're an institutional investor and you want to buy, a couple of $1 billion of the S&P 500,
the privacy is important,
right? You do not want that to be, as you start buying, to be published on chain, because people will front run you, and you will pay the price of going into that. That can be solved as well.
That was great. I'm going to maybe close this out by pushing you once more on 4 trillion to how much in 2030?
10.
Okay, I think it would be a bigger number than that, but I mean it's but towards a faster but steadier big number over the years. Fascinating.
I hope you're right.
Yeah. And, lovely having this conversation, Jacob, and great to have you on Alpha Unhashed.
Likewise. Thank you very much for having me.